Everyone, we'll get started in just a second as everyone filters in. So we're just going to take a second to let everyone filter in. We'll get started in just a second. We're still seeing the numbers jump up. We got a big crowd today, so we're going to let everyone filter in first. Number seems to be leveling off a little bit, Laura. So if you want to go ahead and get started, we will get going.
Sure. I want to welcome everybody to this zoomed in session. We are very excited for today's speaker, a large group today, well over 100, and I hope you enjoy it. I think I'm going to be speaking with you a little bit later once Ryan starts talking about board positions. Ryan Castle, our CEO, I turn it over to you.
All right, thank you. I'm going to run through a couple things here as we get started. Thank you guys for joining us on our Zoomed In on Real Estate. As always, it's presented by the Cooperative Bank Cape Cod, and we actually have Charlotte Green from the Cooperative Bank Cape Cod to talk a little bit today to you guys. And I think that's what everyone wants to also hear about is what's going on in the mortgage markets. But our main guest today will be in the second half of the presentation, Jessica Lautz, the Director of Research at the National Association of Realtors, talk about what home buyers and home sellers are wanting in today's market and what she's seeing in all the research that NAR is doing around today's market. So she's always highly insightful, highly interesting, and we're glad to be able to have her today. Our upcoming virtual CE for the summer, we've got a couple classes, one tomorrow and then next week, and then two more in August. As traditionally, we do not hold in-person classes in the summer. We're not doing that. Our next in-person class will be late September, so be on the lookout for the signups in that soon if you want in person. But as always, we'll be continuing with our online Zoom webinars as well, twice a month. And so here is what's coming up in July and August if you need some classes or have some time and want to go ahead and knock something out on some of our classes. So that's what our schedule is coming up. And then our MLS trainings coming up. We've got one tomorrow on Remind Docs Plus. If you have not gotten into using the new state association member benefit of transaction management that replaces SIP forms and you're interested in how Remind Docs Plus works, you can check it out tomorrow at 9 a.m. Also tomorrow at noon is a class about working with contacts and subscriptions and portals. So how to set your clients up in Flex MLS. That's at noon tomorrow. And then on Thursday at 3:30 is a quick dip, a little quick 15-minute session around coming soon. So if you have questions about what is coming soon, what it means, those kind of questions, jump on with our MLS staff then and get all your questions answered then. So 3:30 on Thursday for that one. Also on Thursday at 11 a.m. is what we've started a couple years ago, and we had a group dedicated to it. Now we just open it up to all membership. But when we get pitched a lot of innovative products or new products starting up in the marketplace, and everyone always wants feedback from agents. So we've set up a thing called Product Lab, which is a way for us to bring you what we think is some cool new things going on in the real estate software technology marketplace. And Offer Form is one of those. And so we got a demo for everyone in our membership to set up on July 14th at 11 a.m. What Offer Form is not, by the name, I thought it was originally like an offer management platform, which we're seeing a lot of out there in the community, but it's not. What it is it's more like a lot of you guys have set up Google Forms or other things to collect buyers' information, right? About what are the terms of their offers that they want to offer on the buyer side when you're the buyer agent. This is a complete product just for buyers agents. And it also collects information around buyers throughout the whole process, and also allows you to customize with videos and other things. It's kind of actually really cool. So I encourage you to take a demo of that if you have time on Thursday at 11, and give us your feedback, whether you like the product, whether you don't, whatnot. So there's some potential partnership options for the association there. So we always like to hear your feedback before we take on new products. And then we have a couple our board director process is open right now. And for those that may not be familiar with it, we have a leadership development committee who, one, recruits and encourages people to apply for our open seats on both the association and MLS board directors. And then they end up making qualifying out candidates to the board directors for a vote as well. So we have several seats up this year. As always, our president-elect is a 3-term year commitment, because you do president-elect, president, immediate past president of the association. Our treasurer is a 1-year term. Both those have prereqs of having to have a good level of involvement at the association before being able to serve on those. So if you have been involved and interested in one of those two, reach out to myself or Marissa, and we can talk you through those eligibility requirements to see if you meet those. Also, we have our small firm director and our large firm director seats open this year. Small firm is if you are licensed with a firm that has 50 licensees or less in Massachusetts. A large firm is if you have 51 or more licensees with that firm in Massachusetts. And an at-large director also for a 3-year term, which is anyone within our membership. On the MLS side, we have quite a few seats open. Our president, which is a 2-year term, is open as well. And if you're interested in that, please reach out to me as well. And then at-large director seats, 3 seats, 2 have 2-year terms, and 1's going to have a 1-year unexpired term. So those are all available. So if you're interested in serving in any capacity, whether you've been involved or not, we always welcome even those that have not been involved to serve on the board if that's more your passion. The deadline to apply is August 15th, but as always, you can reach out to myself, Marissa, anyone on our board of directors or the leadership development committee to talk about more, or you reach out to me and I'll connect you with someone on there to talk more about what it means and some of the opportunities available. So we'd be happy to have you serving. And I think most people say it's a really great experience. They learn more than they actually feel like they even give. And Laura, I don't know if you want to chime in here, about what the value you get out of serving on the board.
Absolutely. When I first joined the board as a small firm director, that was 6 years ago, I really did it for very selfish reasons, because I thought we were so isolated from what was going on in our profession as a small brokerage. I did it to learn more about what was happening nationwide, statewide, locally. And I did. I loved it. I think that it was the best thing I could have possibly done for my own career, for the business at my brokerage. I've enjoyed every minute, and don't be afraid of the time commitment. If you have any questions at all, if you're afraid, how are you going to juggle your day-to-day real estate with obligations of serving as on a position of the board, please reach out to me. I'm happy to talk to you very honestly about the time that is involved and about the very specific benefits that I've experienced so far in my positions. Please apply.
All right, thank you very much. Couple updates on the market. Our July numbers are out, our June reports are out, so please take a look at our websites as they're updated with the new June stats. The one interesting thing that stuck out to me looking at the stats is the month supply of inventory is going up. And I think this is the stat that most of you guys feel out there, right? So if you still look at inventory from last year to this year, we're still down in inventory. But we're down in pending sales, we're down in closed sales. So y'all feel the market softening, but we're not really seeing that real uptick in inventory. When you look year over year, you see it month to month, but remember, seasonally, we always see an uptick in inventory. So we're still seeing new listings down from last year. So where is that feeling you guys have out there? And I think it's in month supply of inventory, which is the amount of time it would take to sell everything on the market. So even though there's less homes on the market, it would take longer to sell everything. And I think that's that slower demand you're feeling out there, whether it's interest rates, whether it's buyer fatigue, whether it's everything probably rolled in together, uneasiness about the economy and where housing prices are going. I think all of that is what you're feeling, and that's being shown probably in that month supply of inventory number. That is how I view it out there. And then the other interesting thing I wanted to point out was the housing affordability index. How the housing affordability index is an index that takes median income, median price of homes, and prevailing interest rates, and how affordable is buying today's market for that median income in today's market. So 120 is the median, meaning that 100, if the index got to 120, higher numbers better for more affordability. If it got to 120, that means a median income could buy a median family home with today's prevailing interest rates. So as you see in the chart, we're down at 43, which means that's about almost 1/3 of, basically our incomes are 1/3 of what it would take. Median incomes are 1/3 of what it would take to buy the median priced home with today's prevailing interest rates. That's kind of astonishing. And I like the historical chart to the right because we have dropped lower than we ever were before. So even in 06, when you had, interest rates that were probably about what they are now, you had housing prices at an all-time high then, and median incomes were obviously much lower than they are now. It still is more unaffordable, has a worse affordability index today, and finally got there. As you see that curve back to here, the blue line is condos, the green line is single family, the green on the left is just single family. So I just thought that was interesting that basically in 2 years we've the affordability, because if you factor in interest rates and rising house prices, has gotten about twice worse. Now we're about 1/3 of what it takes to for median income to buy a median price house. So I thought that was interesting as well to share. But I am going to stop sharing and bring in Charlotte Green. And so Charlotte from the Cooperative Bank Cape Cod, you want to talk a little bit today about what's going on too. So you have a presentation you wanted to go through. If I can turn it over to you.
Certainly. Thank you, Ryan. Thank you all for being here today. I'm really excited to talk about what we're seeing in the mortgage market, and it really mirrors a lot of what you've shared, Ryan, and those are great, fascinating stats to see. So I'm just going to go ahead and start sharing my screen. Bear with me a moment while I did a dry run. All right. So I'm going to jump right into some market trends we're seeing here on the Cape in the financing side. So what people are doing with their mortgages right now. So the market still feels very hot for us. People want to get into these homes and lock into what are still record low interest rates. Ryan, you spoke to the length of time these homes are on the market. So it is starting to feel like we're slowing a little bit based on the timeline those homes are on the market, but still very, very competitive when it comes to making offers and getting those offers accepted. We are writing pre-approvals sun up till sundown, Monday through Sunday, to help our buyer and agent partners get their offers accepted. As you all know, this makes our offers look a lot more competitive, and our mortgage originators are working tirelessly to be there to help crunch payments for people, update pre-approval letters, and make sure that they are able to move quickly when that right house does come along. We're still seeing many cash buyers who are looking for financing to help keep money in their pocket. So a lot of you may have seen this where cash offers come in and then convert to somebody financing. So these folks typically do have the cash to buy, but they are financing to keep the money in their pockets, especially with some dips in the market. They want those funds to rebound before they pull them out of their investment accounts and things of that nature. We're seeing 30 to 45 day closings as the commonplace. Our typical lock periods don't exceed 60 days. I think what's really different here from the COVID era marketplace was that those significant backlogs we were seeing with appraisals and titles are more of a thing of the past. They've leveled out, and those reports are coming back in a timely fashion. So those 30-day closings are no problem, and sometimes they're beating the clock.
Really? So, what goes into that lock? Because I think a lot of people say, oh, you want to lock in your rates, but then I don't think a lot of people understand what that means. And so can you explain what you have to do to lock in that rate?
All right, of course. So once you have a property under contract, you can lock in an interest rate. So that freezes that interest rate for you in time. Typically, rates are changing on a daily basis or multiple times a day. So once you're locked into a rate, you have protection against those fluctuations in the market. And those locks are for a set period of time, typically not exceeding 60 days. So you need to close with.
You need a property under contract, but do you also need to be fully underwritten? Where exactly in the process can you lock yourself in?
You can lock yourself in day one from an accepted offer. You want to make sure you're closing your lock period, and the entire underwriting is going to happen during that time frame. We're going to be ordering the appraisals during that time frame. We're going to be ordering the title reports during that time frame. The biggest thing that we're seeing as road bumps to our closing time frames are title issues, especially when properties get tied up with land court. We have so many old properties here on the Cape. We've got land court. We have multi-generations who are buying and selling homes. So that can create some road bumps in the process, but it's not as frequent as it could be. So we're glad to see that. So in this market, our local banks are your buyer's best friend and your seller's best friend. We have really great interest rates. We're beating the market due to our high liquidity. Our interest rates are significantly lower on our purchase specials than brokers and a lot of these off-Cape banks. So we're really excited when our agents connect us with customers who might be pre-approved with someone off-Cape, because we can save those buyers money on their monthly payments, or we can increase their buying powers. We also have a really great timeline for closing. And the biggest thing is our local vendors and our familiarity with our property types. I just want to share a quick story of a deal that came across our desk last week of someone who was financing with a broker. They had a really great introduction. They thought everything was going well until the appraisal came back. They were buying this beautiful home, half a mile to the beach, ocean views from the top floor, but it is a converted garage property. So this off-Cape lender, who had an appraiser with a license out of Michigan, classified this as a unique property that they couldn't comp out, and the lender would not close. So we're stepping in. We're familiar with this type of property. We finance them frequently, knowing that people are building what they can in the space that they have, and coming in knowing that this is common in the marketplace, similar to those seasonal condos we see, and the accessory units and outbuildings on properties. We're really familiar with these intricacies that sometimes we take for granted as not necessarily being so intricate or unique to the marketplace. That really sets us apart. Also, we're reinvesting in the community that we all love. I can't say enough how much we value our partnership with the Association of Realtors, and really enjoy giving back through our charitable foundation. So I'd be remiss if I didn't talk about interest rates. So I just want to give a quick overview now of what rates have done over the last year. A pretty steep incline from where we were in the 3s to between the 5s and 6s. Just to put that in context though, against the 50-year trends, we are still in record low interest rates, and we are trying to relay that to our customers and give them a little bit more confidence in these rates, this rate market, while they're somewhat adjusting to that press that they've seen for the last 2 years about mortgage rates in the 2%, 3% range. So historically, the interest rate average over the last 50 years for a 30-year fixed rate is 7.75%. The rates right now hovering in the conforming arena in the high 5s are very well below that. The purchase specials that we're running here on the Coop are under 5%, so we are really saving our buyers a lot of money here.
Well, I mean, go back to that chart real quick, because I think that's what I was talking about earlier, right? Like the rates are still actually lower than they were in 06 and 07,
They are.
so, the only when the rates went down was when when the market already crashed, they lowered the rates, right? So, it is good for that historical perspective.
It is good, Ryan, and I think people are just
But the problem
acclimating.
is, I think like 40-year-olds in today's market have never seen rates this high, so they freak out, right? Like that whole, later millennial crowd.
Exactly. And, they're so used to the press talking about these low rates. So now it's not so much in the media. So they're hearing sticker shock when they're hearing these rates sometimes. But what we're seeing right now is a shift in the financing structure for our buyers based on these increased interest rates that are still historically very low. We're seeing a lot more people explore ARMs, which are adjustable rate mortgages, versus the fixed mortgages and the fixed rates that they were trending towards for the past few years. Now, I know ARMs usually have a really negative connotation. People freak out and they think of the 08 market crash. Well, ARMs in this market are very, very different from the ARMs that created the housing crisis back in 08, mainly due to the qualification levels of these borrowers. There are a lot of regulations put in place to make sure that these customers can afford these mortgages, not only today, but when they adjust down the line as well. So these adjustable rate mortgages are not as risky as those in the past. They don't have a lot of those negative amortization features, interest only. They're fully amortizing, which means you're paying principal and interest from day one to start paying down that loan balance. And people have a lot of equity in their homes due to the appreciation we're seeing. So I just want to state that the ARMs really are not as risky as they have been in the past. And we're seeing a big shift back to those in popularity because they're traditionally a little bit lower than our fixed rate interest rates. Right now, we are seeing the local banks beating the market and saving buyers thousands of dollars over the life of their loan, or increasing their buying power from day one. The local banks are really flush with liquidity still left over from COVID and lots of PPP funding. So what we're doing
Charlotte,
is,
you will lend under conventional limits. You'll still lend and portfolio it so that you get the lower rate versus selling it off to Fannie Mae.
yes, we will. We recognize that the folks who are buying in that conforming limit, those are usually our locals, our folks who have affordability issues. So we wanted to make sure we were offering them the most competitive rates we could, same in line with those jumbo buyers. So those conforming buyers are getting really, really great rates with us right now. And it's great to talk to them and hear the reaction, especially if they've started their financing journey elsewhere, because we have the technology, we have the responsiveness, and we have the rates that really help, in certain instances, change someone's life with the savings that they're seeing.
And where are you jumbo rates? Like where are they compared? Are they the same rate as what you're giving within the conventional loan limits for your portfolio? And are they the same rates, or is jumbo higher, or how does that work?
Jumbo is lower on a refinance basis. For our purchase specials, we're running the same rates for our conforming loans and our jumbo loans. Right now, our 30-year fixed is at 3.5%, and we have a 10-1 ARM, so fixed for 10 years, adjusting once a year after that at 3.75. So people are really excited when they hear those numbers and see what it can do to their payments.
All right, cool.
Right. Thank you for asking that one, Ryan. These interest rates have somewhat slowed those bidding wars, as I'm sure you've all seen, that were so commonplace in the COVID market. People have been asking me for a while about, are we going to see a bubble? I think what we're seeing more is a cooling of the market versus a bubble. The Cape is such a desirable area that we are not going to see a crash in these values. We might just see the rapid appreciation cool off a little bit. We're also seeing what feels like more listings coming on, which is due to the length of time those are staying on the market. But we're anticipating a lot of these sellers who've been on the fence are going to be motivated to list in order to capitalize on high values. And like I said, get in before the market might cool a little bit and before buyers limit themselves in the buying power if rates continue to increase. There is going to be a Fed meeting at the end of July. We're anticipating a 75 basis point increase that doesn't directly affect your mortgage interest rates. It directly affects home equity line of credit or a HELOC, but we're loosely correlating with those Fed rate increases. And there was a lot of reaction early this year to the fact that Fed came out and said, every meeting this year, we're going to hike up rates. And that was when we saw that really rapid jump that you saw in that first slide, early 2020, where we spiked up significantly quickly. We think that that might have been kind of a knee-jerk reaction, and the market is leveling out a little bit after an initial significant increase to those interest rates. But the Fed is anticipating to continue raising those interest rates. We haven't heard anything other than them wanting to keep them high.
All right, thank you, Charlotte. Oh, you guys.
There's my wrapping it up for you, Ryan. So takeaways that the local banks like the Coop are really familiar with our Cape market. We're offering super competitive interest rates to help your buyers, and referring local helps your buyers save money, and it'll give your buyer and your seller the added confidence that their closing will be smoother than a DQ soft serve.
All right, thanks, Charlotte, very much. And now I want to turn it over to Jessica Lautz from National Association of Realtors. And you've heard her several times in the last couple of years, but she always has great, insightful things. So we wanted to bring her back in to see what she's been working on, what research she's been conducting and looking at, and what's on her mind, because what's on her mind is probably what's on home buyers and home sellers' minds at this point with how much she surveys them. So Jessica, I'll turn it over to you.
Great. Thank you so much for having me this morning. So I do have a few slides on the economy, but you know what? I'm going to go so quickly through those because that was a great presentation, Charlotte. I caught the end of it. So thank you for doing the hard work for me. So I appreciate that. So I would just the economic fundamentals, obviously inflation, we're seeing it high. I will say from the realtor perspective, you're feeling it probably more than other people out there. One, because you're feeling it in your gas pump, and two, because you're feeling it with your consumers who are saying this is a very hard time and a hard environment to rent a place right now. And I'm seeing my rent go up, but this is also cutting into my spending when I think about saving for a down payment. So those are the two ways that I think realtors are probably seeing it more than other folks out there in the economy. The other thing that we are seeing, of course, is that rates are up. I have right here in a chart that for a $300,000 mortgage, which was way under the median home price, that would be a $500 jump. So if we're talking about a first-time home buyer out there who's trying to jump into this environment, thinking about adding $500 to a monthly payment as a first-time home buyer is so out of reach for so many Americans. We're going to narrow the pool of home buyers that we have right now. It's going to be wealthier buyers who are jumping into this environment. And that's really what we are seeing. When we look at the housing inventory overall, we have near an all-time low of inventory in the market. We have towards the lowest that we have seen since 1999. It actually did hit the lowest in January or February this year. We still have strong demand. I think CEOs are still having an equilibrium of what they're saying is their return to work orders versus you can work from your vacation home or you can work from a nice location and you don't actually have to work from a city center. And so with that equilibrium, this I think is a very interesting time where we are still seeing that people are saying, I've been sitting on the sidelines. I've been having a hard time jumping into this environment. I've had a contract that I have not been able to get accepted. I've been on 1 million homes at this point, worked with my agent for a very long period of time. And now perhaps there is this ability to actually jump into the housing market because there was that rush to lock in low rates at the beginning of the year. Now we have this normalized pace. When we look at this environment, what I think is very interesting is that even though we have this rise in mortgage interest rates, we're still seeing a rise in home prices. They're a little stickier. They're still holding on. We're still seeing a 15% increase year over year. This is not what our expectations were jumping into the year. We actually expected that home prices would moderate sooner than they are right now, but we are still seeing this double-digit pace, and that's making it very hard for home buyers to jump into this environment. And we're seeing this in every MSA of the country is year-over-year increases in home prices. And it's been happening for an extended period of time, 123 months at this point. What we do expect for year end is that home prices would moderate back down to 8%. So that's stronger than what our original expectation was, just because we still see in the month of July that home prices are still going up. So who in the world can buy in this environment? So your first-time home buyers obviously really getting hit right now. That's a very hard environment for a first-time home buyer to enter into with this housing affordability at such a crunch with this rise in home prices and rise in interest rates and inflation. That's a lot of negative right there. So what we do see is that a quarter of buyers are still all cash buyers. We still see mom and pop investors coming into this market. It could be someone who's Airbnb, VRBOing their property for a part of the year. They're investing. They think that this is an investment property, but it's also a vacation property. There's no clear lines at this point, I think, with those. But we also see that it's still a competitive market. Instead of having more than five offers for every home that was listed, now we're seeing this back down to 3 and 4. So this is a little less competitive, but it's still a pretty competitive market. And so a quarter of home buyers are still waiving the inspection. They're still waiving the appraisal. Now that could be because they're an all cash buyer. And so they don't need that appraisal to obtain mortgage financing. So that's something they can jump into the transaction without. But I do think that it still remains a pretty unusual environment. When we look at the forecast for this year, I want to say that with these headwinds that buyers are having, it does not necessarily mean that we're going to have this massive contraction in home sales. And so Charlotte touched on that. Are we going to be in this bubble environment? And I would say that's really not going to happen. So when we do look at this and we look at the forecast, what we do see here is a contraction activity back down to a 2019 pace, not a very steep contraction activity. And so this is Lawrence Yun, our chief economist's forecast for this year. And so I do think that that is pretty promising, because when you look at 2019, it was actually a pretty strong year of home sales. All right, so now I want to jump into everyone's favorite topic, millennials. Are you guys so excited to talk about millennials? They are talked about incessantly, but I do think it's incredibly important when we talk about this environment and we talk about the lack of inventory that we have and the underbuilding we've been doing for more than a decade now in housing, how that's impacting the biggest generation of adults. And when we look at this, what we can see just off the top is that 43% of all home buyers today, 43%, are millennials. So this is the biggest section of home buyers out there today. They really are a force in the marketplace, and they range in age from young 20s all the way up to 41 years old. So let me show you some data and show you this on a graph here. When we're looking at the US populations overall, what we can see here is that smack dab in the middle of this chart are millennials. They're represented by the blue, every other generation broken out by a different color here. The young babies born in the last year, pandemic babies, Gen Alpha, silent generation. You can see the bars get shorter as we know that, lifespans are not passing 100, unfortunately, for many adults, though huge celebration when that does happen. What I want to show you and really pull out here from millennials is that they are the largest generation in the US right now. Smack dab in the middle of the millennials is this red bar. That is the median age of a first-time home buyer. It's 33 years old. So first-time home buyer jumping into the market for their first time. That's exciting. That's something to celebrate. What becomes a concern for me when I look at the inventory crisis and when I look at the affordability crisis, and I think, how are we going to bring more units into the US right now? How are we going to build to have these units available? And why I think this is not a problem that's going to go away overnight is when we look just past that, it is the biggest population in the US. And those young adults are aged 26 to 32. They're entering into their peak household formation years. And so these adults are trying to find a place to live. And maybe that's a rental unit, and that's crunching rental prices as well. And so we're seeing these big gains in rental prices, or it's crunching home ownership. And so we're seeing these big home price gains, and we're seeing very limited housing inventory. All of those things are true. The median age of first-time home buyers, it hasn't changed. It's been really boring. It's been really flat. It really is late 20s to early 30s. When we look at the median age of repeat buyers, this is another reason why we are having a crunch in inventory. So when we look at this age, what we can see is that the typical repeat buyer back in 1981, 40 years ago, was 36 years old. Today, the typical age of a repeat buyer is 56 years old. That's quite the change. They're buying a primary residence at this age, when in the past, and we look at past generations, they had been looking at retirement ages. They had been looking at downsizing, but instead what we see is this 56-year-old likely has kids in their home, is planning on living in that home for 15, 20 years and actually aging in place. So that's a very, very big difference in the intention of that property than what we had seen for past generations at that age. The other thing that we do see is that in last year, there was a slight uptick in first-time home buyers. I do not expect that this year at all. In fact, I should have taken this chart out because I think at this point in time, we're probably seeing this downwards trend because of affordability. But last year, we did see a slight uptick. Some of that is just sheer population. So we know that there is a lot of young adults and they're aging in, right? So that would make sense. The other thing that's behind this number, though, is that we have a lot of parents who are helping with generational transfers of wealth. And so they're helping their young adult enter into home ownership. And maybe that's down payment assistance. Maybe that's helping with closing costs, but they're helping them financially. And so we do see that that is one of the big drivers of first-time home buyers entering into the housing market right now. Nearly a third of first-time home buyers had down payment assistance from mom and dad. The other thing that I want to talk about when we talk about millennials is disproving that avocado toast meme. It is so old at this point to talk about that, but I do think it's really important when we talk about where is spending going for young adults today compared to boomers at the same age. And were boomers spending their money the same way as junior is today? And the answer is no. What we can see really quickly on this chart here is younger boomers, when they were under the age of 25, were spending under 30%, they were spending 29% of their income was going towards housing. Today it's 35%. So it's a huge jump in the amount of money that's going towards housing today. And that's probably rental units when we're thinking about young adults under the age of 25. The other thing that we can see here really quickly is there's actually less spending on transportation. So more young adults taking rideshare services, not even getting their driver's licenses until a later age. I was so excited at 16, I wanted my driver's license immediately. But we do see that for young adults today, that's not actually as common. The other thing that we see here that is a shift too is rideshare services and public transportation and such, but we also see a shift in education. So we can see that 4% was being spent on education for younger boomers. Today, it's 7%. So obviously college costs have gone up. There's more focus on attending college. And so we have more people going to college. And so all of that is really rising that expense for young adults today in comparison to in the past. When we look at student loan debt, it's a huge issue. When we look at young adults today, I would just flag that I'm in the DC area. I'm at home today from my home office because they're doing construction on our floor today. And so they said, you should probably go home. So I am here, but I will say in the DC area, in the Boston area, most educated areas in the country, I think Denver as well. What happens though, when we have this really high level of education is of course student loan debt. And so when we look at young adults today, 60% of millennials are saying that student loan debt is delaying them from purchasing a home. It's not a surprise when we know that the median amount of debt is upwards of $30,000 and keeps ticking up. So that's going to be a hurdle in saving for a down payment along with all the other expenses. And we see for higher income individuals, they probably think that homeownership is within reach, but unfortunately their student loan debt is one of the big hurdles that is holding them back. One of the things that I also want to talk about when we talk about young adults is just this meme of they're in their parents' house, they're in their attic, they're in their basement, you can't shake them, they won't leave, you can't get rid of them, right? We hear this a lot, we hear this trope. And if I was in the room with you, I'd probably have you raise your hand and tell me, do you have a young adult at home? Because I know the median age of members, and you may actually have a young adult at home. So I get it. I understand it. My little sister at the beginning of the pandemic, she said, you know what? I'm working at a nonprofit. I make nothing. Can I come and live with you and save for a down payment? And I can pay down my student loan debt. I can pay off my car, and I really could save for a down payment. And of course, because I work in this industry and I really wanted her to do that, I said, sure. Over the course of the pandemic, she now works at a bank and she now is a homeowner. Thank goodness. She had been in my house for a very long period of time. As a single female buyer, though, she really had to scrimp and save, and she did have to change jobs, and she did have to make those financial sacrifices. That is not uncommon. We do see that single women actually are the most common population to actually move home and do that. But the share of young adults who actually moved back home during the pandemic actually was at all-time highs that census has recorded back to 1960. So we saw nearly 18% of young adults 25 to 34 moved home during the pandemic. So we see that trending downwards right now, but it's still a very large share of the population who was living at home. And I will say that my sister's story, not super unique, 21% of first-time homebuyers moving directly from their family members' home into homeownership. It really can be a boost if that is available to young adults today. And certainly we see them taking advantage of that. So one of the big things that I would really urge you to do, especially in this environment with affordability, is so difficult. And we look at our housing affordability index, which we release on a monthly basis, and we do see that it really has become the most difficult environment for home buyers to enter into, is just to talk about down payments and what the typical down payment is for home buyers. We recently did a survey of consumers, and there is a massive misconception out there about what the typical down payment is. 16 to 20% or 35% believe the typical down payment that you need for a home is 16 to 20%. 10% believe you need more than 20% for a down payment. This is where you can get the word out and tell consumers, potential home buyers, you don't necessarily need to bring all of that to the table, and that there are low down payment programs available in communities. FHA loans allow you to put down just 3%. We also know that VA loans, USDA loans, all of those have been very underutilized. And if you were a home buyer coming into a seller and you had one of those loan products over the course of the last couple of years, you probably were just kind of not accepted, right? So we've done a survey of realtors, and the majority of you have worked with a client who have had to have that conversation where you had a contract that was just not accepted because of the loan product. But if there's less competition in the market, and if the home buyer can afford that monthly payment with the rise in rates, perhaps this is the environment that they can enter into because there is less competition. So that could be an opportunity there. When we look at the typical down payment for first-time home buyers, it's been just 6 to 7% for the last several years. It's never been as high as 20%. Looking over the course of our data, that dates back to 89. What we do see here, even for repeat buyers in the market, is that 17% of them, or the typical down payment is 17%, sorry. We don't see that they're putting 20% down. So even with all the housing equity that they've gained in the last couple of years, they're not even putting down 20%, even with all of that. I do want to go over just a few changes that we are seeing as well when we look at demographics and when we look at home buyers overall. So I'm going to give you 3 quick slides on this to really show you what we are seeing here and how it has shifted over the last few years. When we look at multi-generational buyers, this is something that I think is quite interesting. And I know that your area of the country actually has a lot of ADUs, and some of that's probably for vacation rentals, but some of it actually could be for multi-generational home buyers. We've actually seen that 15% of home buyers at the very beginning of the pandemic purchased a multi-generational home. So the number one reason to do that was for protection of older relatives, to keep them safe from the pandemic. Also for child rearing. It became very difficult for working parents to think about online schools and Zoom schools and so on. And so an aging parent in the home is probably an extra set of hands with that. We did see in the last year that multi-generational home buying, where you have an older parent, when you have an older kid over the age of 18, it has gone back down to just 11% of all home buyers. One of the things that I haven't spent time on in this presentation is looking at the Black, African-American, and the white gap in homeownership. If we saw any closure within that gap, or if we had any closure within the Hispanic white gap or the Asian white gap, what we would see is more multi-generational home buying. And the reason why I say that is that we see that nearly a quarter of minority home buyers are actually purchasing multi-generational homes. So if we had that increase, we absolutely would see more home buyers coming into this environment who were purchasing multi-generational homes. The other big trend that we are seeing here is a baby bust overall. We know overall in the US that birth rates have gone down to a 100-year low. In the most recent year of data, we did see that birth rates went slightly up for women who are in their 30s, but overall in the US, we do see a retraction in this. why am I talking about this? Why does this reflect to home buyers? What we do see here is when we look back at 1985, 58% of home buyers had a kid under the age of 18 in their home. Today it's just 31%. It's not as common for sure. This has an influence on what the home buyer purchases because it's going to change the size of the home they need. It's going to change the neighborhood they need. It's also going to change the number of moves because if you have a growing family, you need to move to accommodate that new baby. And in that home, you need an extra bedroom, more space, a child's play area, yard, all of these things go hand in hand. But the other thing that it does change is if you're a downsizer and suddenly you're an empty nester and you can move and you don't have to be in that perfect school district anymore. Maybe you can have the water view you've always wanted instead, something along those lines, right? And so that's going to change that as well. But we see those moves really being taken off the table. We see tenure in home has risen over time. And so that's something that's very interesting that is impacting this activity. And I know it's a much lighter note, but we do see that dog parks are so important to young millennial buyers in comparison to the location of school. So there really is a switch that's going on when we think about the location, when we think about housing priorities for young adults today. The other thing that we are seeing is there is a drop in marriage rates. There is a graying of divorce. It's not necessarily just first-time home buyers. There's a lot of single adults out there. When we look at the US overall, what we see is back in 1960, more than 70% of adults were married. Today, just half of American adults are married. Now, I keep hearing it's going to be the year of the wedding. We're going to have this marriage boom, but I'm also hearing there's a divorce boom going on. So it's evening itself out. When we look at the data for home buyers, especially for first-time home buyers, we really see this trend mirrored. So back in the 1980s, 75% of first-time home buyers were married. Today, it's just half of first-time home buyers are married. So really seeing this drop in this overall. On the flip side, we see a rise in single females. So my little sister represented in those numbers there. We also see a rise in unmarried couples purchasing homes together. So perhaps they'll get married later, perhaps they won't, but they are purchasing a home together. We also do see, and it's not necessarily for first-time home buyers, but we do see it for older home buyers, is that we actually see there's roommates purchasing homes together. So affordability, companionship, all of those things, such an added bonus. And you get that housing equity, right? So all of those bonuses for these older home buyers purchasing homes as roommates. All right, so how in the world does the agent fit in? I've covered a lot of ground. I talked about economics. I talked about millennials incessantly, one of my favorite topics. I talked about these demographic changes. How do you fit in? So here's the thing. It's really, really important. You are critical to this transaction. What we do see today is that 87% of buyers used an agent in their transaction. They absolutely want you. When we talk about younger buyers out there today, this is one of the huge misconceptions that's out there. What we see is that younger home buyers are actually using agents at higher rates than other home buyers today. So they want your expertise. They want you to find that right home, but they need help actually negotiating that contract and locking that down. And so that's where you come in to advise them through that process, to be the local expert, to understand every step of that process. Especially when we think about the chart where I showed you that so many young adults are moving directly from their family member's home into homeownership. That means that they may have never rented. They could have gone from a college dorm back home, saved money, and now are buying their first house. In that situation, they absolutely need your help. Now, one of the things that I would say is that their parents are probably in tow, and that's going to be a challenge as well to overcome. But it will be very interesting as we see these young adults come into this environment, and as we already are, how they are navigating that transaction. It really is with you. When we look at the seller side of the transaction, we do see that 90% of sellers are using an agent in their process. And we ask a follow-up question here. We actually ask, did you use a broad range of services, limited service agent, someone who does ad hoc tasks? There's so many business models out there, very dynamic. What we do see is that for home sellers today, what they want is someone who does provide that broad range of services. They want the one-stop shopping where you are going to find them the expertise to really bring them to that closing table. They are contacting their agent before that home is listed. Tell me how to fix up that home for sale. Tell me what to do here in every step of that process to get a good price, to market this home. And then tell me at the end of that transaction, after I've moved into my new place, who do I contact for contracting services? Who do I contact for my painter and my mover and so on? Because you are that contact for them. When we look at FSBO sales for sale by owner, we actually see it at a historic low of just 7%. It's the lowest we've recorded in 40 years. When we ask a question about iBuyers, I know that there has been questions about this in recent years, but we actually see it less than 1% of sellers who go on to purchase another home are using an iBuyer service. So they really do want to have the best price available when they do go to sell their home. They don't want to miss out on that housing equity that they really have gained in the last couple of years, especially. And so that's not something they want to leave on the table. So that's what I have for you for my slides. I'm happy to take any questions if we do have time, but I will toss it back to Ryan. So thank you.
Yeah, we do have time. So if you have any questions for Jessica in there, and I have one for you. I've been worried this whole time during the pandemic that, and we knew that we're seeing about 20% decline in home sales this year. Really a lot of inventory driven, right? We've depleted all our inventory. How much, looking back in 09, 10, and 11, we probably borrowed a bunch of buyers from 13, 14, 15 with the home buyer tax credit. How much did the pandemic borrow buyers? Because every time I talk to our members, I ask, did you have anyone that bought during the COVID era that wasn't ever going to buy on the Cape before the COVID? And everyone says, no, they were eventually going to buy. They just moved up their time frame. So I just, in a place where we don't really build any new construction, I really worry that all we did was really borrow buyers, and we're going to see a prolonged decline, flattening of home sales moving forward because we borrowed so many buyers who moved up their plans. Are you seeing that around the country? Are you feeling that yet? Are you seeing any data around that?
All right, Ryan, well, I have to tell you, honestly, you're the first person to ask me. So no, I haven't heard it around the country. It doesn't mean though, I think you're often ahead of the curve. What I would say is that it is very possible that people did move when they didn't expect to, right? So we all had something in our life that happened over the last couple of years. Maybe that's a loss, maybe it's needing support system around us, maybe it's work changes. And so that allowed us to move to a different area and want a bigger home because we need that home office. Something happened, right? It's largely that it would be rare for someone to be untouched over the last couple of years. What I would say about moving up the timeline though, and that did create some migration patterns around the country, is that we have this wave of young adults. They're there. They may not be mortgage ready. They may be saddled with student loan debt. So we are not lacking for buyers moving forward. So maybe it did move up the timeline for some individuals, but we really do have this population glut that is coming in and they are ready to actually purchase homes.
Yeah, I guess in our market, I'm a little worried that it's not our market that they're gonna, be ideally purchase homes in. So we'll see that. I think that's something to keep in mind, right? Because like we said, you can't keep, like I think you pointed out, and this is what I've been pointing out, is home sales are about what they were in 19 or 18, right? And those weren't bad markets. They're just not 2020 and 2021 home markets. And
right.
And that is a big distinction I think people need to see when you're looking at year over year numbers, is that you're going off the high point, the high water mark of the number of transactions.
Yeah, absolutely. And, I would say just from an economics perspective, that the last couple of years, it was not great. It was frenzied activity. It was bad for home buyers. It created, I think, pretty unrealistic expectations perhaps for sellers, but also just a difficult market for everyone out there today, and especially agents. Just that agent fatigue of trying to get a contract accepted, that's real when you're working with a client and really struggling with that and having a hard time.
All right. I don't see any questions coming in here, but I know if you get us over your presentation, we'll distribute that out in a wrap-up email as well. So that'd be great. And thank you so much for taking the time. I appreciate it. Your wealth of information as well. So
thank you. Thank you so much for having me.
All right. Thank you guys very much for joining us today. Get you out in right at an hour. So have a good day. And thank you guys very much for participating.